Hi and welcome to Swissquote's Daily Market Talk. It's November 28th. The markets are calm as US traders are busy eating turkey and buying stuff at discount. The US dollar is better bid and sterling and gilts are giving back gains as investors just realize that avoiding a crisis is not enough to call the end of the British budget worries. The technology stocks, on the other hand, see little appetite in Asia, while the Federal Reserve's 25 basis point cut, if materializes, wouldn't be sufficient to back a further rally in global assets. As we are heading toward the last and most exciting month of the year, we will discuss about why we may or we may not see Santa joining in this year. But before we do, please keep in mind that opinions are my own and this is not financial advice. Yeah, it's boring when the US is not here, right? All the show, the drama, the buzz, the rumors stop all of a sudden, and we are left to look back and think. So let's think. Let's think about what happened this month. It was a harsh month, to say the least. The S&P 500 companies actually announced strong earnings last quarter. The earnings growth was an impressive 13.4% for the entire index. Healthcare, financials, and consumer discretionary were leading sectors, along with technology. Of course, most of the big technology names in the West reported better than expected earnings last quarter and strong and stronger than expected guidance, including Nvidia, of course. But instead of being the best day of the earnings season, the Nvidia's earnings day turned into drama. Investors, too used to blockbuster results from Nvidia, decided to dig into the report this time, and what they found didn't really please. The gap between the accounts receivables and the incoming cash, along with swelling inventories, became the focal point all of a sudden and added to circularity concerns around the latest AI deals. So Nvidia's earnings that were supposed to give comfort to technology investors had the exact opposite effect this time. The bad press took over and the things have been quite downhill since then. Earlier this week, Nvidia was trading up to 20% lower than its latest peak of a month ago. Meta, on the other hand, is accused of offloading its debt to private equity companies to keep its own books clean, and the circularity of the deals around OpenAI are also disquieting, with OpenAI itself is being highly criticized right now. But the good news is that the Fed does jumped in right at the right moment just last Friday to make sure that the technology-led rally in the US doesn't reverse and take the global stocks down with it. The probability of a Fed cut went from below 30% last week to 85% this week, giving the world a bit of space to breathe as the US left for their Thanksgiving celebrations. Since then, nothing much. The European stocks barely moved yesterday, while the Asian technology stocks look bleak this morning, with Alibaba, for example, finding no support whatsoever after announcing strong results a few days earlier, and the news that they've already introduced AI glasses to compete Meta, but in vain. The Hang Seng Index looks uninspiring this morning to global investors, and the Korean Kospi and the Japanese SoftBank, which are the few names that I watch every morning to feel the heat in the technology sector and among the technology investors, are struggling. For the S&P 500, the expectations for future quarters have softened. Projections are now pointing at lower revenue growth over the next 5 quarters for the entire index, ranging between 5 to 8%. In contrast, according to FactSet, analysts are expecting higher earnings growth for the Magnificent Seven companies over the next 4 quarters, somewhere between 18 to 25%. Meanwhile, the valuations are higher than the 5 to 10-year averages, and there should be a correction a bit more than 5% to call it a correction. So here we are at the door of December, and I'm already being asked whether we will see a Santa rally this year. And my answer is hard to tell. Hard to tell really, because there's so much uncertainty in the market right now. Uncertainty regarding the AI valuations, uncertainty regarding the Japanese yields, as Takaichi is there pushing for higher spending and higher borrowing for the Japanese government, that's pushing the yields higher, and uncertainty of course regarding what the Fed will do and what the Fed should do. What is the right thing to do? And even though I believe that the best thing to do for the Fed this December would have to just sit and wait a month and deliver a rate cut when the sky is clear and the data is out, the inflation data, remember, which is due a week later than that decision. But truly, given the Fed probabilities and the wild swings that we have been seeing in this probabilities since last week, it would be dramatic for the Fed expectations to snap back to no cut. It would just inject an incredible amount of volatility in the global financial markets and make the Fed look kind of foolish. And they really don't need that right now. So we will probably get that 25 basis point cut in December, guys. The question is, what happens next? So if the inflation report remains as subdued as it has been the rest of the year, the way could be actually clear for a Santa rally this December, because no one wants to book their profits after such a stellar year, right? But then we could see some profit taking in January or February. Or we get a hot inflation report after the Fed decision that vanishes the dream of 2026 cuts. And we are talking about 2 to 4 cuts here during next year, and the sell-off in equities deepens before the year ends. And regarding the accuracy of the US data that everybody is talking about, well, I would say that it will take some time to see and understand whether the data is being tweaked to serve the White House's lower rate ambitions. Until then, it's speculation. Voila. It's speculation. It is important for sentiment, but still very speculative. So the US dollar is preparing to close the week on a slightly better note, and returning above the 200-day moving average could eventually help the greenback stay on course for further recovery of this year's heavy losses. The downside potential in the euro is certainly limited, as the European Central Bank is not willing to cut the interest rates further, as the policy there looks and feels like being in a good place at the moment, a very rare feeling indeed. In Japan, the story remains quite the same. The dollar-yen will probably continue its journey north along with the rising pressure on JGBs, while the sterling sees the post-budget appetite gently wane. The gilt yields rebounded yesterday on realization that the budget, though eventless and drama-free, didn't necessarily hint at sustainably better fiscal picture for the United Kingdom. And it cannot. It cannot, because when productivity and growth slow, the only way to get more money in is by collecting higher taxes and also by issuing more debt. Good news is, more taxes could be disinflationary, and the Bank of England could simply get back to cutting the interest rates from December already. So cable looks good to sell to me at the current levels. In the commodity space, gold is back to gains as softening Fed expectations over the past week and lower US yields have been backing inflows into the yellow metal. And that's fantastic, because gold is acting again as you would expect it to act, shrugging off the impact of the speculative moves of late summer, while crude oil, on the other hand, is better a bit into the OPEC meeting of this weekend. OPEC is expected to reiterate its intention to pause the production increases when it meets this weekend to relieve the downside pressure that we've been seeing on oil prices since a few months now. Indeed, oil prices have been falling this year, and they have been falling despite many rate cuts from major central banks, including the European Central Bank and the Fed, and lower US dollar, both fundamentally supportive of oil prices normally. So what that means is that the ample OPEC and the ample non-OPEC supply has weighed heavier on price dynamics this year than the US dollar and lower yields. So OPEC knows that if it wants to throw a floor under the cheapening prices in the oil markets, it must restrict production some way, either by preventing additional barrels to come to the market or by restricting production again. But the thing is, OPEC's share in the global oil market has been narrowing, meaning that lower supply from OPEC alone and even potential fresh supply restrictions may not reverse the bearish trend if the US keeps drill baby drill. So the outlook remains quite bearish for oil at the moment. On that note, this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week. And until then, good day trading and have a lovely weekend.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.